For decades, there was a prevailing sense of security in the halls of power in Washington. It was a dangerous assumption, the idea that Canada would always fall in line, staying firmly within the orbit of the United States, especially when it came to the rising influence of China. This belief, however, wasn't built on a foundation of true equality. It was built on habit. And as we've seen throughout history, when habit is mistaken for loyalty, collapse doesn't always happen with a bang. Often, it arrives quietly. That long-standing illusion finally cracked the moment the Prime Minister of Canada boarded a plane bound for Beijing. There was no fiery rhetoric, no public declaration of war, and no grand ideological shift. Instead, it was a calculated move, one rooted deeply in the cold reality of economics. While Washington was busy tightening the screws, imposing a 25% tariff on automobiles and auto parts, and signaling that access to the American market now required absolute obedience, Ottawa was looking for an exit. The stakes here are massive. We are talking about nearly 500,000 Canadian workers whose livelihoods depend on a cross-border supply chain that was never designed for trade warfare. But under the previous administration, trade stopped being a partnership. It became a loyalty test. Instead of retreating, Canada changed the board entirely. This wasn't about choosing sides, it was about survival. Before we dive into how this shift is rewriting the map of North American power, hit that subscribe button. We're tracking the stories Washington doesn't want you to look at too closely. You won't want to miss what comes next. For decades, the relationship between the United States and Canada followed a remarkably predictable script. Ottawa aligned, Washington decided, and the markets adjusted. It was a system that worked as long as access to the American market remained stable. But that stability vanished the moment Washington reframed trade not as a partnership, but as a loyalty test. Under the Trump administration, we saw a fundamental shift in how power was exercised. Tariffs stopped being viewed as temporary tools for negotiation. They became permanent pressure. The imposition of a 25% tariff on automobiles and auto parts wasn't just an economic move, it was a high-stakes political signal. For Canada, this wasn't just a policy headache, it was an existential threat. Think about the scale here. Nearly 500,000 Canadian workers are tied directly to cross-border automotive supply chains. This is a system where components often cross the border multiple times before a final vehicle is even assembled. It's a model built on the assumption that trade flows freely. When those tariffs arrived, they didn't hit the boardrooms first, they hit the shop floors. Consider the story of a mid-size auto parts supplier just outside Windsor, Ontario. This company employed nearly 300 people, with its largest customer being a U.S.-based automaker. After the tariff announcement, orders slowed within weeks. It wasn't because the demand for cars had disappeared. It was because the uncertainty became too expensive. Executives froze investment, overtime was cut, and expansion plans were simply shelved. This is the context you have to understand to see why the Prime Minister's trip to Beijing was so significant. When policy shifts with every election cycle, predictability disappears. And in the world of global trade, when predictability disappears, reliance becomes vulnerability. Washington's assumption was that pressure would produce compliance, that threats would narrow Canada's options. Instead, they did the opposite. They expanded them. For the first time in years, Canada signaled that diversification was no longer optional. It was insurance. This wasn't a move to replace the United States, but a calculated effort to reduce single market risk. In pure business terms, Canada was hedging. When the Prime Minister's plane touched down in Beijing, the optics were, to put it mildly, uncomfortable for the Biden and Trump camps alike. But if you were looking for fiery rhetoric or a public confrontation with Washington, you were looking in the wrong place. There were no dramatic speeches and no ideological declarations. That restraint, it was entirely intentional. The message being sent back to D.C. was simple and tightly controlled. Canada was open for business, but it was no longer willing to operate under coercion. Behind closed doors, the discussions didn't center on symbolism or political alignment. Instead, they focused on the cold, hard fundamentals of global trade: market access, regulatory predictability, and long-term supply security. While Washington's power players assumed that increasing pressure would force Ottawa into submission, they fundamentally miscalculated. Instead of narrowing Canada's options, the pressure expanded them. This is the middle power strategy in action. For generations, Canada's economic model was built almost entirely on proximity, staying close to the U.S. and depending on its policy stability. But the sources make it clear. When trade is weaponized and access becomes conditional, reliance becomes vulnerability. When American policy began shifting with every election cycle, predictability, the one thing markets crave most, disappeared. China, despite its vast complexities, offered something that Washington was no longer guaranteeing: scale, consistency, and long-term demand. Let's be clear. This wasn't about Canada choosing China over the United States. It was about survival. In professional business terms, Canada was hedging. They no longer viewed diversification as a luxury or an optional side project. They viewed it as strategic insurance. By choosing control over dependency, Canada signaled a quiet but irreversible turning point. From this moment on, Ottawa's trade strategy stopped being reactive to the latest tariff threat from Washington and started being proactive. They weren't abandoning the partnership with their southern neighbor. They were simply abandoning the dependency. While the headlines often focus on the gleaming factories of Ontario, the first real shift in this power struggle didn't happen in a boardroom. It happened in the fields. For years, Canadian agriculture was quietly squeezed between shifting global politics and a new era of American protectionism. Farmers exporting canola, wheat, and soybeans, the literal backbone of the Canadian prairie, found themselves acting as collateral damage in a dispute they didn't start. The losses here weren't just theoretical or part of a white paper. They were absorbed by families. Canadian farmers lost billions of dollars in revenue over multiple seasons. Think about a third-generation grain farmer in Saskatchewan. While Washington was signaling that trade access could no longer be taken for granted, this farmer was watching his margins collapse. As costs for fertilizer and equipment maintenance rose, the price of his crops slid because his primary markets were being weaponized. Small towns felt the sting first. Equipment purchases were postponed, seasonal workers weren't rehired, and local banks began tightening their lending. This was the moment Ottawa realized that agricultural dependence wasn't just an economic issue, it was a national risk. But then came the pivot. That trip to Beijing produced immediate, tangible results where Washington's pressure had failed. Quiet negotiations led to the removal of agricultural restrictions, reopening a market of more than 1 billion consumers. Suddenly, the door was back open. Canola prices stabilized, and wheat contracts returned. In Manitoba, one cooperative reported export volumes rebounding by more than 20% within a single cycle. This wasn't just about cash flow. It was about strategic value. By diversifying, Ottawa gained leverage it hadn't possessed in decades. For the United States, the impact was subtle but real. American exporters started facing stiffer competition in Asian markets, market share that once defaulted to U.S. suppliers now had alternatives, and pricing power began to weaken. As the sources point out, this wasn't retaliation, it was redistribution. When access is weaponized, suppliers look elsewhere, and once those buyers adapt, they rarely return under the same terms. Agriculture proved that diversification works. It protects rural economies, but more importantly, it reduces a nation's vulnerability to political pressure. We see the numbers, but I want to hear from you. Does a more independent Canada make North America stronger or more fragile? Drop a comment below. I'm reading your theories. Now, we need to talk about the real shock in this realignment. It didn't come from the farms or the fields we just discussed. It came from factories that hadn't even been built yet. For years, Washington treated the automotive future like a sequel to the past, prioritizing bigger engines, bigger trucks, and short-term margins over long-term transitions. But while the U.S. was looking in the rearview mirror, Canada was looking at the numbers. They saw that electric vehicles, EVs, were no longer a luxury experiment, they were an absolute inevitability. This is where Washington made a massive strategic error. By weaponizing tariffs on steel and aluminum, the U.S. inadvertently drove up the costs of its own supply chains. That inflation didn't stay in the boardrooms, it hit the consumer directly. Suddenly, American-made EVs became more expensive not because the technology was failing, but because government policy made them unaffordable. While the U.S. was pricing itself out of the market, Canada was opening a different door. During those quiet meetings in Beijing, the focus wasn't on ideology, it was on pricing. Chinese manufacturers were already producing reliable, mass-market EVs in the $35,000 to $40,000 range. For a suburban family outside Toronto, facing a fixed mortgage and rising fuel costs, a $40,000 EV that lowers operating costs actually makes sense. By exploring regulatory flexibility, Canada didn't just buy cars. They positioned themselves as a strategic bridge where affordability and industrial growth could finally align. The consequence for Washington is profound. By insisting on rigid trade alignment, the US didn't stop the EV transition. It simply slowed its own progress while Canada moved forward. The US is now losing more than just sales. It's losing its grip on global standards, pricing benchmarks, and the pace of adoption. Once an ecosystem like this takes root, it locks in the labor, the logistics, and the suppliers for decades. This was never just about cars. It was about who controls the next global industrial platform. By opening its doors selectively, Canada gained something Washington is currently losing: bargaining power. They can now negotiate for technology transfers and local assembly that will sustain their workforce for a generation. As it turns out, protectionism doesn't slow change, it just redirects it toward the people willing to adapt. If electric vehicles were the visible shift in this global realignment, then strategic minerals were the quiet foundation beneath it. For years, Washington talked a big game about energy independence, but they overlooked a critical, physical reality. Electric vehicles don't run on political slogans, they run on nickel, lithium, and cobalt. And as it turns out, those materials are not evenly distributed. Canada sits on some of the most stable and accessible reserves of these minerals in the industrialized world, specifically across northern Ontario, Quebec, and Western Canada. For decades, these resources were treated as secondary exports, important, certainly, but not strategic. That changed the moment tariffs exposed just how fragile American-led supply chains had become. The United States suddenly discovered a problem it couldn't fix with a press release. Mining takes time. Permitting takes years. Infrastructure takes decades. While Washington was bogged down in policy uncertainty, Canada moved with a clarity that China understood perfectly. If you control the inputs, you influence the outputs. But look at the way Ottawa played this hand. The focus wasn't on simple ownership or selling off land, it was on stability. Canada needed investment without surrendering its sovereignty, leading to a model of joint ventures with guardrails. This wasn't extraction at any cost, it was about anchoring the processing and refining of those minerals right there on Canadian soil. Why does that matter? Because raw exports create revenue, but processing creates power. Take a small mining town in northern Ontario with a population of just 5,000. For years, it survived on seasonal work, but a new processing facility changed that entire trajectory, creating hundreds of permanent jobs and local training programs. For Canada, this is what the sources call strategic insulation. By keeping the processing at home, they reduce their exposure to the very tariff swings and export bans that Washington has been using as leverage. The consequence for the United States is direct. American manufacturers now face tighter supply conditions, rising prices, and lead times that just keep extending. They are now competing for inputs they no longer control. When partnerships are treated as leverage, partners seek balance, and Canada just found its scale. Minerals create leverage. But factories? Factories turn that leverage into raw industrial power. While Washington was busy announcing its clean industry ambitions with press releases, tax credits, and political slogans, Canada was busy pouring concrete. They understood a fundamental reality that DC seemed to miss. If you control the inputs and host the factories, you control the future. Ontario has quickly become the center of gravity for this movement. With an existing skilled labor force and stable energy, Asian investors began quietly moving capital into southern Ontario, not for speculative projects, but for long-term plants designed to operate for decades. We are talking about investments exceeding 10 billion Canadian dollars. This isn't just a win for the balance sheet, it's a win for the people. Consider a former auto worker in Oakville. After being laid off during previous restructuring cycles, he retrained through a battery manufacturing program and is now earning a stable wage again. It's the same industrial backbone, but with a new, more resilient technology. The reason capital is flowing north is simple: predictability. Investors value continuity more than they value fluctuating incentives. While Washington struggles with policy reversals and election cycle uncertainty, Canada is offering a steady hand. Every battery plant built in Canada reduces its future dependence on American trade policy. The strategic impact is clear. Canada no longer needs permission to industrialize. They aren't just participating in the new economy, they are anchoring it on their own terms. This isn't just a story about Ottawa and Washington. It's a preview of a broader global realignment that is happening without the headlines. Middle powers across the map, from Japan and South Korea to parts of Europe, are all reaching the same conclusion. Diversification isn't disloyalty, it's insurance. They are quietly recalculating their exposure, moving away from a system where access to the American market feels conditional rather than permanent. For For the United States, the lesson is a difficult one. Power used frequently as a blunt instrument like constant tariff threats eventually loses its effectiveness. By trying to force alignment through pressure, Washington didn't produce obedience, it accidentally encouraged independence. Ultimately, Canada's move wasn't a betrayal or a pivot toward an ideological ally. Canada didn't choose China. Canada chose control. They didn't abandon the partnership with their neighbor. They simply abandoned the dependency. This is what strategic autonomy looks like in the 21st century. It's found in supply chains, not just in speeches. The global economy isn't fragmenting, but it is rebalancing. And that rebalancing favors those who have the vision to plan beyond the next election cycle. Which of these shifts, agriculture, electric vehicles, minerals, or manufacturing, do you think will have the greatest impact on the global stage over the next decade? Share your thoughts in the comments. And if you want to be the first to understand where the next wave of global power is heading, make sure you are subscribed. I'm your name, and we'll step into the next chapter together.